economic managers remain confident the country will bounce back despite getting a negative outlook. That Secretary Carl Chua says the Philippines kept its rating above investment grade, still showing a good sign for growth. Debt watcher Fitch Ratings earlier revised its outlook to negative because of the mounting debt and shrinking economy. We break down these numbers with Banco de Oro Chief Market Strategist Jonathan Ravelas. Jonathan, thank you so much for joining us. I mean, with this downgrade of the outlook from Fitch Ratings, are we on our way towards a credit rating downgrade and even losing our investment grade rating status?
Good evening, Rico. It's a writing on the wall that we need to do better. At the moment, we've already seen signs of recovery from GDP all the way to import growth, and eventually we even saw manufacturing slowly normalizing. So it will actually take more time to probably see that recovery continue. Of course, the concerns that Fitch have highlighted, particularly for the delays in the vaccinations and eventually the rising debt. We can, once we're able to increase more of this vaccination, we can further reopen the economy. And that's just what we need to ensure that recovery takes place.
But Jonathan, you know, you said the writing on the wall. The writing on the wall really is looking very bold right now. I mean, we are in the money laundering gray list. You mentioned about the debt, a record high 11 trillion pesos. It's a debt mountain that each Filipino owes the local and international lenders 100,000 pesos each. The country is dead last in the latest global finance list. And now, this outlook downgrade. What will save us from this credit rating downgrade?
Well, so far, if you actually look at what you reported earlier, that we have the lowest case in the last 3 weeks. If you compare the Philippines against our ASEAN peers, we rank number 4 at the moment in terms of new cases. If we're able to maintain this low cases, we can further reopen the economy. What we just need to do is increase the vaccinations, increase more of the information of preventing COVID, which is the mask, hugas, iwas, and bakuna, so that we can further reopen the economy. That's what we need. We need to build that confidence so that we can normalize.
But in the meantime, of course, But in the meantime, Jonathan, while our outlook has been downgraded, does this have any kind of impact on the cost of money? Will interest rates rise? Are we going to see a far weaker peso against the US dollar?
Okay. If we tend to look at interest rate, I think it's more of a knee-jerk reaction. We're starting to see recoveries, and even in terms of revenues, the government has already started to show signs of increased collections coming from customs. We're also seeing recently the government looking into new revenue measures, and I think one of the things that is pending in Congress is basically the additional mining taxes. Hopefully they're able to pass that, and you have a new set of revenues to generate more fiscal spending. And one thing to note is that we have a lot of potential to restart the economy with our infrastructure program. We only need to further reopen the economy. That's what we need to do now. So hopefully the next few data, which is the GDP come mid-August and the state of inflation, we could probably see more signs that the economy is on the recovery path.
But, you know, Jonathan, you have a weaker peso, right? It's now at 50 to the US dollar. You have the rising price of crude, and this will raise the cost of goods and services, which would translate eventually to more suffering for the people. And according to the latest SWS survey, more of our kababayans are now going hungry. Will this make matters worse?
Well, right now we're seeing inflation in average 4.3%. So this is eventually where we are right now. So two things can eventually happen. One is that at present, where the exchange rate is, creates competitiveness for us. Second, it will eventually allow more foreign direct investments to come into our country once we restart the economy. And we've seen a lot of potential investors looking into the Philippines again.
Yeah, briefly.
The only thing that...
Briefly, Jonathan, apart from Fitch, are we also likely to see a downgrade from the likes of Standard & Poor's and Moody's following in the same path as Fitch?
Well, basically, Moody's recently made a comment in one of the reports that they're looking at the same recovery that we're seeing at the moment. It's just, it will take a longer time to probably see those. And that's, I think, are the green shoots that we're also seeing. So hopefully, we get to see hopefully a better Christmas this year. And one of the things that created the surge in the peso was also the start of import recovery. So what caused the peso to further go beyond 50 was the taper talk.
Yeah, Jonathan,
so
we have
created that knee-jerk reaction.
Sorry, I have to jump in here. We have 15 seconds before the end of our interview. Tell us, where do we see the peso dollar at the end of the year, and where do you see GDP growth?
Okay, we're looking at GDP growth at 5.5% to 6%. And in terms of the exchange rate, we're seeing more of an appreciation probably towards the 49.50 as we get to see the strength of remittances, which has already started to show its resurgence as jobs are slowly being reoffered, as most of the developed economies are slowly going back to normal.
All right. Thank you so much for joining us in the final word. Jonathan Ravelas from Banco de Oro.